So let's talk about Nebius, because they have what you might call a high-class problem. Demand for their AI infrastructure is completely through the roof, so much so that their biggest challenge isn't finding customers, it's just building data centers fast enough. This quarter's story is all about one thing, a race to close that gap. It's a $5 billion bet where everything now hinges on a single word, execution. You know, in a market this hot, you've got to ask the essential question. What is the one thing, the single biggest thing, holding a company like Nebius back? And the CEO, Arkady Valosh, he didn't mince words. He was crystal clear. It's not about competition, it's not their technology, it's not even sales. It is all about physical capacity, period. And honestly, if you grasp that one point, you pretty much understand their entire strategy right now. Okay, so let's dig into that. Just how big is this demand we're talking about? Well, big doesn't even cut it. The word management used was overwhelming. And here it is, the headline number that really jumped out this quarter, a massive, new, $3 billion 5-year deal with Meta for their AI infrastructure. But listen to this, because the story behind that number is what's really telling. The CEO admitted, straight up, that the deal could have been even bigger. Meta wanted more, but Nebius literally didn't have the hardware to sell them. Just think about that. And remember, this deal is stacked right on top of that colossal agreement with Microsoft from last quarter. When you put these two together, you're looking at a gigantic backlog of future revenue. For an investor, that kind of visibility is just golden. This quote from the chief revenue officer, well, it says it all, doesn't it? He said his team generated a $4 billion pipeline in Q3 alone, and that he's had to learn how to turn business away. I mean, what an incredible position to be in. So, how do you solve a problem like this? There's really only one way. You have to spend, you have to build, and that is exactly what Nebius is doing with a very aggressive new expansion plan. And I'm not talking about a small tweak here. They are more than doubling their capital expenditure guidance for 2025, from around $2 billion all the way up to $5 billion. That's not just stepping on the gas, that's hitting the nitrous button to meet this demand. The CEO gave a really smart breakdown of the spending. It happens in 3 stages. First, securing land and power. That's cheap, only about 1% of the total cost. Next comes building the data center shell, which is about 19%. But the vast majority of the money, we're talking 80%, is for the GPUs. And here's the key. They only spend that big chunk of cash when the demand is already locked in. So it's aggressive for sure, but it's also incredibly disciplined. And this chart right here perfectly illustrates the new scale of their ambition. They've raised their target for secured power, that's the fuel for future data centers, by 150%. They're going from 1 gigawatt to 2.5 by the end of 2026. That's a massive signal about their future growth potential. Now, this kind of explosive growth is incredibly exciting, but let's be real, it's not cheap. So let's flip the coin over and look at the financial trade-offs Nebius is making right now. First, the good news, and it is really good. The top-line growth is just staggering. Revenue is up 355% year over year, and their core AI infrastructure business, that grew by 400%. Just wild numbers. But that growth came at a price. Capital expenditures in this quarter alone were nearly $1 billion. To put that into perspective, that's almost 7 times their revenue. This is what investing for the future really looks like. So that brings us to the big question for any investor watching this story. How are they going to pay for this $5 billion build-out? Well, management laid out a clear 3-part plan. They're going to use corporate debt, asset-backed loans, which is pretty clever. They're basically loans secured by those giant customer contracts, and of course, equity. A key piece of that equity plan is this new at-the-market program. It's just a much more flexible way for them to sell shares and raise capital as needed without the huge disruption of a single large offering. And the CFO, Dana Alonso, got right out in front of the biggest concern with any equity program, shareholder dilution. She made it very clear that they're focused on balancing the urgent need for capital with protecting shareholder value. Okay, so where does all this spending and building actually lead? Let's take a look at their ultimate goal. And this is the target. By the end of 2026, Nebius is aiming for an annualized revenue run rate of $7 to $9 billion. If they can pull that off, they're going to be a major player in the global AI infrastructure market. But here's the part that makes that huge number feel so much more credible. The chief revenue officer added that more than half of that target is already booked. It's locked in from existing long-term contracts. So a big chunk of that future revenue has already been sold. And in his letter to shareholders, the founder made it clear that this period of intense building, it's just the beginning. The goal here is to create a massive platform for growth that will last for years and years to come. So what's the bottom line for investors? It's pretty simple. The demand is there. The financing plan is in place. The long-term vision is clear. It all comes down to execution. Can they manage the incredible complexity of this massive global build-out and do it fast enough? That is the key question.